Imagine stepping onto your own private jet. You know, the scent of fine leather, the soft hum of the engines, that promise of effortless travel, bypassing every mundane airport hassle.
Hmm.
It's really the epitome of luxury, speed, and, well, unparalleled exclusivity.
Yeah.
But beneath that polished chrome and those bespoke interiors, there's always a deeply intricate business model at play, navigating the currents of a really demanding market.
Oh, absolutely. And today, we're peeling back the curtain on one such fascinating company, taking you right into the cockpit of its financial reality.
That's right. We're embarking on a financial deep dive into flyExclusive Inc., trading under the ticker FLYX.
Yep, FLYX. And this isn't merely about, glancing at stock prices. It's about truly understanding the engine under the hood of a company operating in the high-stakes, high-glamour world of private aviation.
It's a sector that promises incredible luxury and convenience, for sure.
But it often comes with significant operational complexities and capital demands that can truly test a business model.
Yeah.
It's not an easy game.
No, definitely not. So your mission, should you choose to accept it, is to cut through all the noise. We've compiled the latest data, everything from core financial metrics and intricate ownership insights to recent news headlines and analyst perspectives, basically, to distill the essential nuggets of knowledge about FLYX.
Right. Our goal is for you to walk away from this deep dive with a clear, objective, and really comprehensive understanding of this fascinating company's financial landscape.
Yeah, helping you feel genuinely well-informed, ready to contribute to any conversation about the private jet market. Okay, let's unpack this. So let's start by getting a clear picture of who exactly flyExclusive is. This company, flyExclusive Inc., is fundamentally an owner and operator of private jet aircraft.
Okay.
Pretty straightforward there.
Right. But they don't just ferry people around. Their focus is on what they describe as curated private aviation experiences.
Curated. When you hear curated, what immediately comes to mind is like an attention to detail, right? A personalized approach that goes way beyond the standard charter flight.
Exactly. Their stated commitment goes right to the heart of customer service in that ultra-luxury space, surpassing passenger expectations for quality, convenience, and safety.
So it's not just about getting from A to B.
No, it's about the entire journey, from booking to landing. The company was founded relatively recently, back in 2015, by Thomas James Seagrave Jr., and it's headquartered down in Kinston, North Carolina.
Okay.
And that dedication to an elevated experience, making sure every aspect of safety and convenience is covered, well, that's paramount in an industry where clients expect nothing less than perfection for the premium they pay.
Yeah, you're talking about a very specific high-end clientele who expect seamless, highly personalized service.
Definitely.
And what's particularly interesting about their strategic approach, and something that immediately caught my eye, is their ambition to be a vertically integrated private aviation company. We hear that term often in, like, manufacturing or tech, but how does vertical integration translate when you're talking about flying luxury jets and catering to that kind of discerning clientele? What's the real benefit here? And maybe what are the challenges they face taking on so much in-house?
Well, it's a critical and, frankly, ambitious strategic pillar for them. Their stated mission is to become the world's majority vertically integrated private aviation company.
Wow. Majority vertically integrated. That's a bold claim.
It is. For flyExclusive, this isn't just a buzzword. It translates into handling a significant portion of their operations entirely in-house. This includes comprehensive maintenance, repair, and overhaul services, what we usually call MRO.
Right, MRO.
But they take it a step further. They also manage their own aircraft paint shops, interior refurbishment capabilities, and even avionics services.
Huh. So they're doing the interiors, the paint, the electronics, everything.
Yeah, pretty much. They essentially control the entire life cycle of their aircraft, from acquisition and customization to ongoing operations and maintenance, right down to the aesthetic finishes and the sophisticated electronic systems inside.
So they're not just flying the planes. They're essentially customizing, maintaining, and fixing them, becoming a kind of one-stop shop for their own fleet.
Exactly.
Why is taking on that level of control and complexity such a big deal for a private aviation company? I mean, what are they gaining by doing this themselves, and what might be the trade-offs? Seems like a lot to manage.
It's fundamentally about control, efficiency, and consistency, all aiming, really, to deliver that premium experience we talked about. This strategy aims for several key benefits. First, capital-efficient program growth.
Okay.
By internalizing these services, they hope to grow their fleet and operations without, blowing through excessive amounts of cash on external third-party services, which can be costly and less predictable.
Right, those external vendors can add up.
For sure. Second, it supports an industry pricing model, potentially allowing them to offer competitive rates or maybe maintain healthier margins by controlling their own cost base rather than relying on external vendors who add their own markup.
Makes sense.
Third, and this is critically important for any airline, is optimal dispatch availability.
Getting the planes back in the air quickly.
Exactly. If your planes are in-house for maintenance or repairs, you can ideally get them back in the air faster, maximizing their utilization and revenue-generating potential. External MRO can lead to delays, significant downtime.
Yeah, you lose money when they're on the ground.
You do. They also emphasize in-house training for their staff and ensuring a controlled premium customer experience on modernized aircraft. By managing nearly every aspect, they aim to ensure a consistent, high-quality experience that's entirely aligned with their brand promise.
So less reliance on outsiders who might not meet their standards.
Right, and it significantly reduces the reliance on external vendors, which, again, can add cost, introduce delays, and dilute quality control.
But what's the downside? It can't all be easy.
Well, the trade-off, of course, is the massive upfront capital investment required to build and staff these capabilities. Think about setting up paint shops, MRO facilities.
Yeah, that's huge investment.
And then there's the increased operational complexity of managing such diverse functions under one roof. It's a bold bet, really, on long-term efficiency over potentially easier short-term outsourcing.
That makes perfect sense from an operational standpoint, though. Control, efficiency, the consistent brand experience, absolutely crucial when you're catering to that discerning, high-paying clientele. But yeah, it sounds like it requires substantial upfront investment and very deep operational expertise. A complex beast to manage.
It is.
And speaking of aircraft, what kind of fleet do they actually boast to deliver on these curated, vertically integrated experiences? What's in their hangar?
Well, they boast over 100 aircraft in their owned and leased fleet, which is quite substantial for a private jet operator. Gives them significant operational scale and flexibility.
Over 100, okay.
Yeah, and this includes a versatile range covering light, mid-size, super mid-size, and large jets. So, this diversity allows them to cater to a wide array of client needs.
Right, short hops to long hauls.
Exactly. From shorter regional hops in a light jet, maybe for a quick business trip across state lines, to transcontinental or even international journeys in a large cabin aircraft designed for maximum comfort and range, complete with all the amenities.
And the sources mention specific types.
Yeah, what's specifically noted in our sources is that they are one of the nation's premier citation operators.
Ah, Cessna Citations. Very popular.
Very. This includes popular models like the CJ3 and CJ3 Plus, known for efficiency, the Excel, XLS, and XLS Plus, which are kind of workhorse mid-size jets, the Encore and Encore Plus, the Sovereign, a super mid-size with excellent range, and even the Citation X aircraft, which was famously one of the fastest civilian jets out there.
Wow, the Citation X, that's speed.
It is. Being a major operator of Cessna Citations, which are widely known for their reliability, efficiency, and popularity in the charter market, is a strategic choice. It aligns well with their operational goals and their focus on high-utilization charter services.
So it suggests a balance between operational consistency and catering to diverse customer segments with a proven, well-regarded fleet.
I think that's a good way to put it, yeah.
All right, so we've seen flyExclusive's ambitious strategy and their impressive fleet. But, no matter how luxurious the service or how bold the strategic vision, the financials ultimately tell the true story of how that ambition is translating into performance.
Always comes down to the numbers.
Always. And here, we begin to see some truly interesting and perhaps challenging patterns. They reported sales of $347.75 million. Now, that sounds pretty impressive for what is still essentially a niche luxury market, right?
It does sound like a big number, yeah.
But then, when we look at the bottom line, their income is a negative $27.86 million. What does this immediate contrast tell you? High sales, but losing money.
Well, that's a stark and immediate contrast, isn't it? High revenue, which indicates they're definitely generating significant top-line activity and have a presence in the market, but they're deep in the red on the bottom line, showing substantial losses.
It's like a finely tuned engine that's burning way more fuel than it's converting into forward thrust.
That's a good analogy. It tells us that while they're definitely active in the market and drawing customers, they're just not operating profitably yet. And if you dig a bit deeper into their earnings per share, or EPS, for the trailing 12 months, it stands at a negative $1.18.
Negative $1.18 per share.
Okay.
Not great, but maybe not unheard of for growth companies.
Right. It isn't entirely uncommon for companies in aggressive growth phases, but the figure that truly jumps out and should make any investor, really pause, is their EPS year over year, also on a trailing 12-month basis, which is a staggering negative 193.33%.
Whoa, okay. Negative 1,093%. That number grabs your attention and practically screams.
It really does.
It's not just losing money. It's losing money much, much faster than before. What does this magnitude of negative growth signify in a practical sense for a company like flyExclusive? Does it imply a sudden surge in costs, maybe tied to that vertical integration build-out?
It's a powerful signal, and yeah, it indicates a fundamental imbalance, often tied to significant growth investments. This magnitude of negative growth signifies that their expenses are not just growing, but they're accelerating at an alarming rate relative to their revenue.
Or their revenue growth just isn't keeping pace.
Exactly. Or their revenue growth isn't nearly enough to offset their burgeoning costs. This is often indicative of a company undergoing a massive aggressive investment phase. Think of it almost like a tech startup burning through capital to acquire market share and build out infrastructure.
Right.
But applied here to an asset-heavy aviation business. For flyExclusive, this could certainly be the cost of building out those in-house MRO capabilities, expanding their fleet, or investing heavily in customer acquisition.
So the crucial question isn't just if they're losing money.
Right. It's how long they can sustain this burn rate and what specific operational bottlenecks or market shifts are accelerating these losses so dramatically beyond just simple growth costs. It's a very concerning trend for their path to profitability. It suggests that the benefits of that vertical integration haven't yet offset the significant costs of establishing it, not by a long shot.
That really adds a critical layer to the analysis.
Mm-hmm.
So let's try and dig into why that might be happening by looking at their margins, which offer a window into their cost structure.
Good idea.
What does a gross margin of a surprisingly low 7.34% tell us? I mean, for a service-oriented business in a luxury market, that seems incredibly thin. You'd expect more buffer there, right?
Yeah.
Especially with the premium prices.
It is indeed very low, surprisingly low, especially for a premium, high-value service like private jet charter. For context, gross margin reflects the profit left over after deducting the direct costs of providing their services.
So fuel, pilots, direct maintenance.
Exactly. Things like aviation fuel, pilot and crew salaries directly tied to flights, direct aircraft maintenance for operational readiness, maybe aircraft leasing costs for their fleet. A 7.34% gross margin suggests that an extremely high proportion of their sales revenue is immediately consumed by these direct operational expenses.
Yeah.
There's very little profit left over from just delivering the core aviation service itself to cover all the other broader aspects of running a large company, the administrative stuff, sales, marketing, overhead.
So it points to a highly cost-intensive operation where even the core service delivery is barely breaking even, if that, from the gross perspective.
Pretty much. It really highlights the inherent challenges of this business model. The dream of luxury comes with the reality of significant operational costs that eat into revenue right off the top.
And it only gets, well, more concerning from there because the operating margin then plummets further to a negative 17.37%.
Mm-hmm.
Yeah. What does that deeper dive tell us about their broader operational efficiency once all the other business costs are factored in? This is where a company like flyExclusive, with its ambitions of vertical integration, should theoretically be finding some efficiencies, you'd think.
Well, the operating margin is crucial because it accounts for not just those direct costs of services we saw in gross margin, but also all the other ongoing operating expenses.
Like HQ staff, marketing budgets?
Right. Things like administrative overhead, sales and marketing efforts, general and administrative costs, maybe R&D, though probably less applicable here. Negative 17.37% operating margin means that even after factoring in the revenue generated from their flights, they are deeply unprofitable once all their operational expenses. The costs of simply running the business day to day are factored in.
So the vertical integration savings haven't kicked in yet or aren't enough?
It seems that way. It indicates a fundamental challenge in their operational efficiency and cost control. While vertical integration promises long-term efficiency, in the short term, the costs of building and maintaining those capabilities, like those in-house MRO shops and staff, can be substantial before the full benefits are realized.
So it suggests that their core business, after all is said and done, is not generating enough revenue to cover the costs of simply keeping the lights on and the business functioning.
That's what it looks like. This is either a period of very heavy ongoing investment, or it's a sign of significant structural challenges in their cost base that they need to address.
And the ultimate bottom line, the profit margin, simply confirms this challenging picture. It's a negative 8.01%.
Yeah.
So basically, they're currently losing money on every dollar of revenue they bring in.
Yeah, that's the final tally.
This isn't just a tough quarter or a lean year. It suggests a significant systemic challenge in their core business model to achieve profitability right now. It means for every dollar of service they sell, they are losing 8 cents. That's a tough treadmill to be on.
It really is. The profit margin, or net profit margin, is the final figure. It tells you how much profit a company makes for every dollar of revenue after all expenses, including interest on debt and taxes, have been accounted for.
And negative 8% confirms it.
Confirms that despite their significant revenue generation, flyExclusive is currently losing money on every dollar of business conducted. This points to a fundamental imbalance between their revenue generation capabilities and their overall expense structure.
And without a significant shift here.
Sustained operations become really challenging without continuous external capital infusions. It implies that their stated mission of capital-efficient program growth is facing some pretty significant headwinds when you look at these core profitability metrics.
Yeah, it's a classic situation, isn't it? A company growing its top line, expanding its services, but struggling immensely with its bottom line. Suggests that the scale or efficiency required for profit just hasn't been reached yet.
Not yet, no.
Okay, so we've seen the income statement painting a, well, let's call it a stark picture of their current operations with those accelerating losses. But what about the company's underlying financial foundation?
Right. The balance sheet gives us a snapshot.
Exactly. Let's turn our attention there, which gives us that snapshot of their assets and liabilities at this moment, sort of an x-ray of their financial structure.
Yeah.
And here, a really striking number appears. Their book value per share is a negative $12.94.
Wow. Negative book value.
Yeah. As an investor, what's the first thing that comes to your mind when you see a number like that? Does it set off alarm bells? What are the immediate implications for shareholders?
It absolutely sets off alarm bells, yes. And loudly, for any investor looking at the long-term health of a company, a negative book value is a very significant concern.
Why is it so bad?
It indicates that the company's total liabilities, basically everything it owes to creditors, suppliers, other entities, exceed its total assets, everything it owns, including its fleet of jets, property, cash.
So they owe more than they own on paper.
In simple terms, yeah. From an accounting perspective, if flyExclusive were to liquidate all its assets today, it wouldn't have enough money to pay off all its debts and other obligations.
That sounds dire.
Well, it isn't just a sign of unprofitability. It's a deeper structural issue on the balance sheet. It means the shareholders' equity, which theoretically is what would be left over for owners after all debts are paid, is actually negative.
So the shareholders' slice is less than zero.
Effectively, yes. This often points to cumulative losses that have eroded capital over time, or a very heavy debt load that has accumulated, basically consuming the entire equity base. It implies that the company is technically insolvent from an accounting perspective, though it can continue to operate as a going concern by continuously raising new capital.
But for shareholders, it means their claim on the company's assets is currently negative. Not ideal.
Not ideal at all.
And their cash per share is minimal, just $0.20, which suggests pretty limited cash reserves on a per-share basis.
Very limited.
When you combine that with the negative book value, it doesn't paint a picture of financial strength or, a comfortable buffer for unexpected events. Seems like they're running pretty lean on liquid assets.
It certainly doesn't paint that picture, no. Limited cash per share means they don't have a large buffer of readily available funds. This can make it very difficult to cover unexpected expenses, manage day-to-day operational needs, or fund new growth initiatives without resorting to further borrowing or issuing more equity very frequently.
Which gets harder and more expensive when you're in this state.
Exactly. When coupled with the negative book value, it profoundly underscores a precarious financial position where the company is not only unprofitable, but also appears to have insufficient assets to cover its liabilities and very limited liquid assets to address short-term operational needs.
So it suggests a constant and immediate need for fresh capital just to keep the operations going.
That seems likely, yeah. Which can be a continuous drain and risk if capital markets tighten up.
And the return on assets, or ROA, at negative 4.33%, just further confirms that their assets are not effectively generating profit.
Right.
So even their impressive fleet of over 100 aircraft, which are very expensive assets, aren't pulling their weight, so to speak, in terms of generating a positive financial return for the company.
Precisely. ROA measures how efficiently a company is using its assets to generate earnings. A negative ROA of 4.33% means that for every dollar of assets the company owns, whether it's their aircraft, their MRO facilities, or any other property and equipment, it's actually losing money.
Which, in an asset-heavy business like private aviation,
Yeah.
not what you want to see.
Definitely not. Where those planes are significant capital investments, this is a clear indicator that their deployed capital is not being utilized effectively to drive profitability. It reinforces the picture of operational challenges and high cost we saw in the income statement.
Yeah, it all ties together. A sign that the significant investments in their fleet and vertical integration capabilities are just not translating into positive returns yet.
Not yet. And while the return on equity, ROE, isn't available in our sources, given the negative equity, it would undoubtedly also be deeply negative, which is another significant red flag for investors looking for shareholder value.
Okay, so the overall financial health looks quite concerning from these metrics. Let's move to liquidity. Can they actually pay their immediate bills, their short-term obligations?
The day-to-day stuff.
Yeah, their quick ratio is 0.22 and their current ratio is 0.25. These are both very, very low numbers.
Extremely low.
What do these ratios tell you about flyExclusive's short-term financial health and their ability to cover immediate obligations? And what does it mean for their day-to-day operations?
Well, these ratios are indeed very low, and they signal a tight liquidity position, maybe even bordering on concerning from a going concern perspective. The quick ratio looks at the most liquid assets, cash, marketable securities, accounts receivable against current liabilities. At 0.22, it means they only have 22 cents in easily convertible assets for every dollar of immediate debt.
Only 22 cents on the dollar.
Yeah. The current ratio, which includes all current assets, including things like inventory against current liabilities, is only marginally better at 0.25.
Still really low.
Still really low. Both figures indicate that flyExclusive would likely struggle significantly to cover its immediate short-term obligations if they all came due at once.
So they're juggling things day to day.
It implies that they are highly reliant on ongoing cash generation from operations, which we know is negative, or, more likely, continuous external financing to manage their day-to-day operations and avoid a liquidity crunch.
Which means their financial flexibility is limited.
Severely limited, yeah. For unexpected events or opportunities, like a sudden spike in fuel prices or a major maintenance issue that grounds a plane unexpectedly, they live very close to the financial edge based on these numbers.
And the source material doesn't provide specific debt to equity or long-term debt to equity metrics. But given that strikingly negative book value we discussed,
yeah, you can infer quite a bit from that.
it often points to a potentially high debt load relative to equity, or maybe just a significant equity deficit. This raises an absolutely critical question. How is the company funding its operations and growth, given its current, deeply unprofitable financial state and poor liquidity? It can't just run on fumes forever.
That's the multi-million-dollar question, isn't it?
Yeah.
It really ties everything together. When you have a negative book value, it typically means shareholders' equity has been completely wiped out by cumulative losses.
Okay.
In such a scenario, debt becomes the primary, if not the sole, source of financing for the company's assets. So while we don't have the explicit debt-equity ratios, the implication is pretty clear. They are probably heavily leveraged, carrying a significant amount of debt to finance their assets and operations.
And without positive cash flow from operations.
Which we've confirmed they don't have. They are compelled to rely on new debt, new equity injections, or potentially selling off assets just to fund their continued existence, let alone their ambitious growth plans.
Which puts them in a very vulnerable position.
Very vulnerable. Access to new capital can become challenging and prohibitively expensive for unprofitable companies with weak balance sheets, especially if the broader capital markets tighten or investors become more risk-averse.
And it means future profits get eaten by debt payments.
A larger portion of their future revenue, when and if they eventually turn profitable, would have to go towards servicing that debt rather than reinvesting in the business or returning value to shareholders. It's a classic high-wire act for a growth company in a capital-intensive sector.
So we've dissected the financials, and the picture isn't exactly sunny, to say the least. Now let's shift our perspective and see how the market is actually valuing flyExclusive, or FLYX, in light of all these financial realities.
Right. What does the stock price tell us?
We have a market capitalization of $296.48 million. This, of course, is the total value of the company's equity in the market, essentially what shareholders think the company is worth.
Okay, just under $300 million market cap.
But then we have the enterprise value, or EV, which stands at a much larger $738.45 million.
Wow, that's a big difference.
Yeah, that's a significant difference, more than double the market cap. What does that wide gap immediately tell us about flyExclusive and its financial structure?
That difference is profoundly significant and directly echoes our earlier discussion about the balance sheet and the company's likely debt situation.
So?
Enterprise value factors in not just the market capitalization, but also a company's total debt, minority interest, and preferred shares, while subtracting its cash and cash equivalents. So if the enterprise value is substantially higher than the market cap, as it is here by over $440 million,
Which is a huge gap.
it strongly suggests that FLYX carries a very substantial amount of debt or other similar liabilities on its books. This reinforces the implications we drew from their negative book value, that debt is playing a very large, arguably dominant role in financing their operations and asset base.
So it's a clear signal of high leverage.
A clear and unmistakable signal to investors about the company's overall financial structure and its high leverage. When you buy a share of FLYX, you're not just buying a piece of the company's future potential. You're implicitly taking on a share of that substantial debt burden, which can definitely impact future profitability through interest expenses.
Okay, so a significant portion of that enterprise value is effectively debt, highlighting a highly leveraged structure. Now let's look at some sales-based multiples, since traditional earnings multiples are clearly not applicable here, given their unprofitability.
Right. PE ratios are out the window.
Exactly. Their price-to-sales, or PS ratio, is 0.85. What does a PS ratio below 1 typically imply about how the market is valuing its revenue? Especially for a company like this, it's losing money on every dollar of sales.
Well, a price-to-sales ratio below 1 can imply several things, especially for a company that isn't currently profitable. In a general sense, it might suggest that the market views the company's revenue stream as less valuable than the price of its stock, perhaps due to those persistently low margins we talked about, the high associated costs, or fundamental questions about the sustainability or growth prospects of that revenue.
So it could mean undervaluation sometimes, but maybe not here.
Exactly. While a PS below 1 could sometimes indicate undervaluation for a profitable company, for FLYX, given its deeply negative operating and profit margins, a PS of 0.85 likely signals that investors are deeply discounting the value of each dollar of revenue because so much of it is being consumed by costs, leaving little, if any, for profit.
It's the market saying, yeah, you're generating sales, but at what cost? And what's actually left for us, the shareholders?
That's a good way to think about it, yeah.
Then there's the price to cash, or PC, ratio, which stands at 18.74. Now, this seems quite high for a company that's not profitable and has very limited cash per share, as we discussed.
Yeah, 18.74 PC seems a bit rich, given the context.
What might this peculiar combination suggest about how investors are viewing FLYX? Are they just, I don't know, hoping for a completely different future, or is there something else at play here?
You're right to notice that anomaly given their current cash position and unprofitability. A high PC ratio, especially for a company that isn't generating positive earnings or significant cash flow from operations, could suggest that investors are indeed looking beyond current cash generation.
Betting on the come, essentially.
Maybe. They might be anticipating significant future cash flow improvements, perhaps from the eventual maturation and cost-saving benefits of that vertical integration strategy, or maybe from growth initiatives finally achieving scale and profitability that will throw off substantial cash later on.
Or maybe valuing intangible things.
Or it could suggest that investors are valuing aspects of the business not directly tied to current cash generation or profitability, like market share in a niche luxury space, the brand equity they are building, the long-term potential of their expanding fleet and operations, or even the speculative potential of future acquisitions or a buyout.
So it's just a strong forward-looking perspective from the market.
Very forward-looking rather than backward-looking perspective, yeah. Perhaps based on the belief that current investments and losses will eventually lead to substantial cash generation. It's really an investment in a vision, a story, not current performance.
And as we've kind of alluded to, traditional profitability multiples like price to earnings, PE, forward PE, and the PEG ratio are conspicuously absent or negative in our sources.
Yeah, they're just not useful here.
Which is a direct consequence of the company's current unprofitability, making standard earnings-based valuation extremely challenging. So investors have to rely on these other more revenue or asset or maybe cash-based metrics, which inherently adds a layer of speculation to the valuation process.
Exactly. When a company is losing money, its earnings per share are negative, which renders PE and PEG ratios undefined or meaningless in a positive investment sense. You can't divide by a negative number and get a useful comparable multiple.
Right.
This forces analysts and investors to pivot and rely on alternative metrics like price to sales or enterprise value to sales, which focus on revenue or overall company value rather than profitability. It really highlights the speculative nature of investing in companies that are in their aggressive growth phase and not yet profitable.
Because their valuation is based more on future, potential, strategy, market position than on current tangible financial performance.
Yeah.
It means you're investing in a story, a vision, a projected future, rather than a proven track record of earnings, which definitely increases the risk profile significantly for many traditional investors. Okay, so we've looked at the financial dashboard and how the market is currently valuing FLYX, often by looking, well, way beyond current profits. Now let's shift gears and look at who actually owns the company, which often tells us a lot about investor sentiment, control, and potential future directions.
Yeah. Ownership is key. Who's behind the wheel?
Exactly. Insider ownership stands at a remarkably high 74.63%.
Wow, almost 3/4.
Yeah. This means a vast majority of the company's shares are held by its founders, executives, and board members. That's an incredibly strong hold, isn't it? What are the implications of such concentrated ownership for the company's decision-making and maybe for other investors?
It's an exceptionally strong hold, and yeah, it's a powerful dynamic. It acts as a kind of double-edged sword.
How so?
Well, when insiders own such a large percentage, it generally means their personal wealth is very heavily tied to the stock's performance and the company's long-term success. This can signal strong confidence in the company's strategy and future. They're literally putting their money where their mouths are.
So skin in the game, a lot of it.
A huge amount. It suggests a high level of conviction in their vertical integration and growth plans. However, it also has significant implications for both corporate governance and market liquidity.
Okay, let's talk governance first.
For governance, high insider ownership means the founding team or core management has significant, if not absolute, control over strategic decisions, the company's direction, even the board's composition. This allows for rapid decision-making and a consistent vision, which can be beneficial, especially for an ambitious strategy like theirs.
But the downside?
But it can also limit the influence of external shareholders and potentially lead to decisions that prioritize insider interests over those of public shareholders, especially if there are conflicts of interest. Minority shareholders basically have very little say.
Right. And what about liquidity in the market with so much stock locked up by insiders? Does that make the stock more volatile for public traders?
Absolutely. In terms of liquidity, with nearly 3/4 of the shares held by insiders, far fewer shares are available for public trading on the open market. This is often called the float.
Okay, the float is small.
Right. This can lead to lower trading volumes and increased price volatility, as even relatively small buy or sell orders from public investors can have a larger and more immediate impact on the stock price than they would for a company with a broader, more widely distributed ownership base.
So it creates a thinner market,
Yeah.
takes less volume to move the price.
Exactly. What's fascinating here, though, is that despite this high insider ownership, the source indicates no recent insider trading for this ticker.
Huh. No buying or selling from them recently.
Well, it doesn't necessarily mean no transactions have occurred at all, but rather no new reports have been filed recently or are available in the data we have. This can sometimes be a function of reporting requirements or maybe quiet periods around earnings. So maybe not a lack of activity, just a lack of recent reported activity.
Okay, that distinction is important. Now, let's contrast that high insider ownership with institutional ownership, which is a much smaller slice at just 8.05%.
Yeah, quite a difference.
Compared to the insiders, that's quite low, indicating that large funds and institutions hold a relatively small portion of FLYX. But here's where it gets truly telling. Institutional transactions show a massive negative 83.27% change.
Negative 83%. Wow.
Yeah. This implies a significant reduction in institutional holdings, a mass exodus, really. What might this signal about their outlook on the company's prospects, especially given their typically rigorous due diligence processes? This seems like a major divergence from that insider confidence.
It is an incredibly powerful signal, and it highlights a stark contrast to the high insider conviction we just discussed. Institutional investors, the big funds, pension funds, endowments, they typically have dedicated research teams, sophisticated models, extensive due diligence processes before they take significant positions.
They do their homework.
They do. When they collectively reduce their holdings by over 83%, as they apparently have here, it suggests a strong negative outlook or perhaps a complete loss of conviction.
Why would they sell off so much?
They might be exiting due to fundamental concerns about the company's persistent unprofitability, its precarious balance sheet with that negative equity, the liquidity issues we talked about, or maybe a lack of confidence in the long-term strategy or management's ability to execute it profitably.
So it's basically a significant vote of no confidence.
From a segment of the market that often has deep insights into a company's fundamentals, yes. It creates a fascinating dichotomy in investor sentiment. Insiders seem to be doubling down, while many major institutions are pulling back significantly.
That divergence is definitely something any potential investor should deeply consider.
Absolutely.
And the numbers on shares outstanding versus shares float further illuminate this dynamic. Shares outstanding are 20.20 million, but the shares float, the number of shares actually available for public trading is only 5.12 million.
Right, so the float is only about 25% of the total outstanding shares.
How does this low float, combined with that incredibly high insider ownership and the institutional selling, contribute to the market dynamics we've been discussing, particularly concerning volatility?
It significantly amplifies potential stock price volatility, creates what's sometimes called a thinly traded stock. With only about a quarter of the total shares freely tradable by the public, even relatively small buying or selling pressure can lead to really outsized price swings.
More bang for your buck or loss?
Potentially, yes. If a few institutional investors decide to sell, as they seemingly have in large numbers, or if a wave of retail investors decides to buy based on some positive news catalyst, the impact on the share price can be much more dramatic and rapid than for a stock with a larger, more widely distributed float.
So this low float, high insider ownership means control is concentrated and market dynamics can have a more pronounced, almost exaggerated effect.
Exactly, making it a potentially very volatile and speculative investment. You're riding a potentially wild roller coaster with maybe fewer safety rails, metaphorically speaking.
Speaking of volatility and speculation, let's touch on short interest. The short float is 4.08%, and the short ratio, which is the days to cover for short sellers, is 11.52.
11.5 days to cover, that's high.
Yeah, a short ratio above 10 is generally considered high, indicating significant bearish sentiment. What does this combination of factors suggest about overall market expectations for FLYX? Is it primarily a warning, or does it also present a peculiar kind of opportunity for some traders?
It's kind of both in a peculiar way, and it perfectly encapsulates the speculative nature of this stock right now. A high short ratio, like 11.52, indicates that it would take over 11 days of average trading volume for short sellers to buy back all the shares they've borrowed and sold short to close their positions.
So it confirms significant bearish sentiment. Lots of people betting against it.
Definitely. Meaning a notable portion of the market is actively betting that the stock price will go down, perhaps seeing those persistent fundamental weaknesses we discussed. They're anticipating further declines, believing the current valuation is too high given the financials.
But the opportunity side?
However, a high short ratio also carries the risk, or opportunity, depending on your perspective, what's known as a short squeeze.
The squeeze.
Yeah. If unexpected positive news emerges and the stock starts to rise significantly, short sellers might rush to cover their positions to limit their potentially unlimited losses. This mass buying by short sellers, as they're forced to repurchase shares, can then further drive the price up rapidly, creating a powerful, albeit often temporary, upward surge.
So it's a clear sign of skepticism, but also a latent source of potential upward volatility if the narrative shifts suddenly.
Exactly, which can be a tantalizing prospect for certain types of aggressive traders, but also a huge risk.
Okay, so we've got a company with a challenging financial picture, incredibly high insider ownership, institutions heading for the exits, and this volatile, low-float, high-short interest situation. Now, let's talk about the stock performance itself because it's been a truly rocky ride, a real paradox of short-term gains against long-term struggles.
Definitely a roller coaster.
Looking at recent momentum, the stock has seen incredible performance, up nearly 50%, 49.19% in the past week, over 50% in the past month, and about 27% in the past quarter.
Huge short-term gains.
Yeah, that suggests powerful, recent upward pressure, almost defying gravity given everything else we've just covered.
It does, and the short-term performance figures show a powerful, almost explosive recent surge. However, zooming out reveals a very different and, frankly, more sobering picture.
What does the longer view show?
Over the longer term, the stock is actually down 6.77% in the past year and a staggering 61.54% over the past 3 years.
Down over 60% in 3 years. Ouch.
Yeah. The company's IPO was back on July 19th, 2021, meaning it has declined significantly since going public, losing well over half its value. So while the recent surge is incredibly eye-catching and has certainly generated buzz,
It masks a substantial long-term underperformance.
exactly, and it aligns much more closely with the persistent negative financial metrics and the institutional divestment we've discussed. It's a classic case of check the longer trend, not just the latest headline, reminding us that short-term bounces don't always reflect underlying health.
Definitely. So what is truly behind this dramatic recent surge in the face of such prolonged underperformance and those deeply negative financials? It's quite the paradox, almost like the stock is operating in a different dimension than the balance sheet sometimes.
Well, that's where news and sentiment come in.
Currently, the stock is at $3.70. Now, that's up a whopping 106.70% from its 52-week low of $1.79.
Big bounce off the low.
But it's still down 24.43% from its 52-week high of $4.90. This just reinforces how much it's bounced around in a relatively short period.
It's a textbook example of how short-term news events and market sentiment can temporarily override long-term fundamentals. This extreme volatility confirms that. Daily volatility is quite high, 22.40% for the week and 13.45% for the month.
Yeah, those are big daily swings.
It reinforces the idea of significant rapid price swings rather than a steady, fundamentally driven trend. What's even more puzzling, though, and perhaps signals some statistical anomaly or just how unique its drivers are, is their beta, which is surprisingly low at 0.18.
0.18 beta, that's incredibly low.
It is. Beta measures a stock's volatility relative to the overall market. A beta this low would suggest minimal correlation, almost as if it marches entirely to the beat of its own drum, regardless of broader economic or industry-wide cycles.
So it suggests FLYX's stock performance is currently driven more by its own story than the general market.
Much more by idiosyncratic, company-specific events and news catalysts than by general market sentiment or the broader economic environment. It's a very specific story, not a general market play right now.
And the technical signals also give us some strong clues about this recent surge. The Relative Strength Index, or RSI 14, is at 70.81. What does that tell us about the short-term buying pressure that pushed it up so dramatically?
Well, an RSI above 70 is a classic technical indicator. It tells us that the stock is in overbought territory.
Meaning it might be due for a breather.
Often interpreted that way by traders, yes. It suggests the stock's recent price appreciation has been very strong and rapid, possibly too much too fast, and that it might be due for a pullback or consolidation in the near term. It suggests that the buying pressure has been exceptionally high and potentially unsustainable in the very short term, indicating enthusiasm might have outpaced fundamentals for a bit.
And furthermore, the stock price being significantly above its 20-day, 50-day, and 200-day simple moving averages confirms this strong short-term bullish momentum.
Right. The numbers there are pretty stark.
Yeah, the SMA 20 is up 42.65%, SMA 50 up 46.2%, and SMA 200 up 31.73%. This clearly shows the stock has broken significantly above its historical averages, riding a powerful wave of positive sentiment or news that has overwhelmed any underlying fundamental concerns for the moment, at least in the eyes of short-term traders.
So all these technical indicators are indeed screaming recent bullish surge. But what about analyst perspectives? We have one analyst, just one, with a target price of $9.
$9, that's way higher than the current $3.70.
Significantly higher. And this translates into a strong buy recommendation with a rating of 1.0. How should an investor view this strong but solitary bullish outlook when contrasted with the persistent financial struggles and that clear institutional divestment we've discussed? Is it a beacon of hope or maybe something to be approached with a healthy dose of skepticism?
Yeah, it's really important to remember that this is the perspective of a single analyst. While a target price of $9 suggests an incredibly optimistic outlook, implying more than double the current price, relying on just one analyst's strong buy recommendation, especially when it seems to fly in the face of the underlying financial struggles, the negative balance sheet, and that notable institutional selling. Well, it requires significant caution.
Absolutely. Look for consensus if you can.
Exactly. It's often helpful for investors to look for a broader consensus from multiple analysts for a more balanced and robust view. This one analyst might be heavily weighting the future growth potential or the long-term success of the vertical integration strategy, perhaps overlooking or downplaying the immediate profitability challenges and the sheer capital required to execute their vision.
It's a leap of faith based on the future.
It really is a very optimistic take, and it's critical for you, the listener, to understand that context and not just take a single recommendation at face value, especially with such a complex financial picture. Okay, so that single analyst bullish outlook and the recent short-term stock surge must be tied to specific news events. Let's dig into those catalysts because they're critical to understanding the current market behavior, particularly that disconnect between stock performance and financial fundamentals.
Right. What's been driving the recent positivity?
For instance, their Q2 2025 earnings, reported around August 13th to 15th, highlighted a revenue surge and fleet modernization. This appears to be a major driver of the recent positive stock performance.
Okay, revenue surge. That sounds good.
It does, despite a previous EPS surprise that was highly negative, remember, at negative 333.33%. However, the quarter-over-quarter EPS did show a positive growth of 19.97%, and sales were up 15.59% QQ. That's important context, isn't it? The market seems to be reacting to the quarter-over-quarter improvement more than the overall annual picture.
Absolutely. The market often reacts very strongly to sequential growth, even if the year-over-year figures or overall profitability remain negative. It reflects a "what have you done for me lately" kind of mindset.
Yeah.
A revenue surge and concrete progress in fleet modernization would be perceived as highly positive steps towards their long-term vertical integration strategy. The quarter-over-quarter growth in EPS and sales, even if from a low absolute base or still negative annually, suggests a positive trajectory in the most recent quarter.
So, signs of a potential turnaround, maybe.
That's how it can be interpreted by investors focused on momentum. A potential turning point, a sign that perhaps the tide is finally beginning to turn, even if only incrementally, from a very challenging financial position. It's the promise of future improvement that excites the market in the short term, especially for a stock that has been beaten down.
And beyond earnings, there were other significant catalysts, like flyExclusive's preliminary inclusion in the Russell 2000 index back on May 27, 2025.
Ah, the Russell inclusion. That's usually a big deal.
Yeah, typically pretty big for small cap stocks, leading to automatic buying, right? It's almost like a forced purchase for certain funds.
It is indeed a significant event, and often a major tailwind for small cap companies. Inclusion in a major small cap index like the Russell 2000 can automatically lead to increased demand for the stock from index funds and exchange-traded funds, ETFs, that track that specific index.
So funds tracking the Russell 2000 have to buy FLYX.
Essentially, yes. These funds are mandated to hold constituents of the index in proportion to their weighting, which creates a built-in passive buying pressure that can drive up the share price, often irrespective of underlying company fundamentals.
It's a pure technical catalyst.
Exactly. A forced inflow of capital that gives the stock a tangible boost. It means institutional money has to buy it, even if their research teams might otherwise be wary based on the financials we've discussed.
They also made a strategic move on February 14, 2025, reaching a definitive agreement to acquire Jet AI's aviation business in an all-stock transaction.
Okay, this acquisition is a clear tailwind that reinforces their stated mission to become the world's majority vertically integrated private aviation company. By acquiring Jet.AI's aviation business, flyExclusive aims to expand its capabilities, potentially absorb more market share, and solidify its control over more aspects of the private aviation value chain.
So the market generally likes these kinds of strategic moves.
Often views such strategic acquisitions positively if they promise long-term synergy, market expansion, and greater control over operations, as this one seems to. The fact that it was an all-stock transaction is also key.
Because they didn't spend cash they don't really have.
Exactly. It means flyExclusive didn't have to burn its already limited cash reserves, which is a major plus given their precarious financial state. However, it does come at the cost of diluting existing shareholders, as new shares are issued to pay for the acquisition.
Right, more shares outstanding.
But still, the strategic alignment and the avoidance of a cash outlay tend to outweigh the immediate dilution in the eyes of investors focused on growth and market positioning. It signals continued ambition.
And credibility is absolutely key in aviation, especially private aviation, where trust and safety are paramount.
Non-negotiable.
Their attainment of the RGUS Platinum Safety Rating around July 15th to 17th, 2025 is a significant credential, boosting their reputation for safety. How important is a safety rating like that for attracting and retaining high-value clients who literally put their lives in your hands?
Oh, that's a truly crucial reputational boost and one that resonates deeply with their target clientele. The RGUS Platinum Safety Rating is one of the highest, most respected safety accolades in the private aviation industry.
It's a big stamp of approval.
A huge one. It signals to potential high-net-worth clients, corporate flight departments, even insurers, that FlyExclusive adheres to the most stringent safety standards and operational best practices, often going above and beyond basic regulatory requirements.
Which builds trust.
Immensely. In an industry where safety and peace of mind are non-negotiable, this credential significantly enhances their credibility and can be a major differentiator and draw for clients who prioritize safety above all else, which is basically every private jet client. It can directly impact their ability to secure new contracts and retain existing ones by building that essential trust.
They've also been consistently active on the fleet modernization front, with the arrival of their 5th Challenger jet on April 21st, 2025, and the launch of new luxury Cessna Caravan services, amphibious ones even, from Tamiami Airport on June 17, 2025.
Yeah, adding metal.
This clearly shows continued investment and expansion of their offerings. It's not just talk, they're putting new planes in the sky.
Indeed. These milestones demonstrate ongoing, tangible investment in their core assets and a strategic expansion of their service offerings. Adding Challenger jets, popular super midsize aircraft, indicates they're enhancing capabilities for longer-range, higher-capacity flights.
Catering to more demanding trips.
Right. And launching new luxury Cessna Caravan services, especially amphibious ones, opens up entirely new market segments, expands their reach to unique, perhaps more leisure-oriented destinations, like island getaways.
So catering to a broader range of premium travel needs.
Exactly. It underscores their commitment to growth, modernizing their fleet, diversifying their revenue streams, all while aligning with their strategic objectives of providing those curated experiences. These are very visible signs of progress.
And financing these continuous moves has involved multiple strategic investments, as we kind of noted earlier, might be necessary.
Right, capital infusions.
We saw $25 million from ETG-FE LLC on January 26, 2024, another $25 million equity investment on March 5, 2024, and a $25 million preferred equity investment on August 12, 2024. As we discussed, this raises critical questions about how they're consistently financing operations and growth, given their persistent unprofitability and limited cash. While it's positive, they're getting capital.
It also highlights a significant dependency, doesn't it?
It really does.
While these successive investments provide much-needed capital to fund their ambitious expansion, fleet modernization, and MRO capabilities, they also underscore the company's continuous and significant need for external funding due to its current unprofitability and negative cash flow from operations.
And these investments come with strings attached.
Always. Equity investments, especially preferred equity, come with certain costs and obligations, and they dilute existing shareholder value. Relying heavily on them indicates that the company is still in a significant capital-raising mode rather than being self-sustaining from its operations.
So this is a critical point to watch.
Very critical. Can these strategic investments eventually lead to sustained profitability and positive cash flow? Or are they merely bridging a persistent funding gap in a highly capital-intensive industry that requires continuous investment just to maintain its position, let alone grow? It puts pressure on them to eventually prove out the strategy with real profits and self-sufficiency.
Finally, on the tailwind side, they've launched new customer initiatives. Things like a new jet club on March 10, 2025, an ambassador partnership with PGA Tour winner Lucas Glover on April 2, 2025.
Targeting the golf crowd. Smart.
Seems like it. And even a $100,000 jet club membership giveaway on May 20, 2025. These are clear, aggressive efforts to attract and retain high-value clientele in a very competitive market.
These are indeed important marketing and customer acquisition strategies specifically tailored for the luxury market. They demonstrate a very proactive approach. A new jet club aims to build a loyal customer base, secure recurring revenue streams, predictable demand, highly valuable in this business.
Yeah, the ambassador.
Leveraging a recognized figure like PGA Tour winner Lucas Glover taps directly into an affluent demographic that values exclusivity and lifestyle, creating aspirational appeal for the brand. And a high-value giveaway like a $100,000 Jet Club membership. That generates significant buzz, incentivizes membership, gets people talking about the brand, potentially going viral within that target demographic.
So these initiatives are designed to drive demand, secure future revenue, build loyalty.
All essential for a company that needs to significantly grow its top line to eventually overcome its substantial cost structure and finally achieve profitability.
Okay, so those are the tailwinds, and they certainly help explain that otherwise paradoxical recent stock surge.
Yeah.
But every story has two sides, and we need to look at both.
Got to look at the headwinds, too.
What are the challenges and red flags that emerge from the news cycle that might temper some of that short-term enthusiasm and perhaps hint at deeper operational or governance issues?
Well, the most significant red flags, and arguably the most concerning from a regulatory and investor confidence standpoint, are the NYSE-American late filing notices.
Ah, yes. That didn't look good.
No. flyExclusive received notices on April 22, 2024, and again on May 28, 2024, regarding the late filing of its annual report, the 10K, and its quarterly report, the 10Q.
That's a serious compliance issue for any publicly traded company, isn't it?
It is. Late filings can signal internal control weaknesses, maybe operational challenges that are distracting management, or even issues with financial reporting accuracy or capacity. It immediately raises questions about the company's ability to manage its administrative and regulatory obligations effectively.
And it unnerves investors.
Definitely. Investors rely on timely, accurate, and transparent financial information to make informed decisions. It's a sign of potential disarray or maybe overextension behind the scenes, or just a lack of robust internal processes needed for a public company.
Yeah, that sounds like a big deal for a public company. It speaks to fundamental operational organization or perhaps a strain on resources. And then there's the analyst downgrade.
Right, the quick flip-flop.
BTI Research downgraded the stock from buy to neutral back in February 2024, only a month after they initiated coverage with a buy. That's a very quick and notable shift in analyst sentiment.
It is remarkably fast.
What would cause such a rapid change of heart, and why is that a red flag for potential investors?
It is, and it's a particularly telling one. For an analyst firm to initiate coverage with a buy rating, which implies a positive outlook and confidence, and then reverse course to neutral within such a short period, just 1 month, suggests that something significant changed in their assessment, or perhaps that their initial positive outlook didn't hold up under closer scrutiny.
So maybe they saw something concerning after the initial look.
Could be. It could point to new, unanticipated information emerging, or a fundamental reassessment of the company's challenges, perhaps related to the accelerating pace of losses we saw, the true capital needs for their strategy, or maybe unexpected operational hurdles came to light.
So this kind of rapid shift is a red flag.
It is, because it indicates a potential loss of conviction even from those who were initially bullish. It adds another layer of caution to the otherwise optimistic recent stock performance driven by other catalysts, reminding us that there are still serious concerns being weighed by professional observers.
Okay, so what does this all mean when we weave it together? Taking a step back to view the full tapestry of flyExclusive. We have a company with incredibly ambitious growth plans and a strong, distinctive push for vertical integration in a truly high-end luxury market.
Definitely ambitious.
They're actively expanding their fleet, acquiring other businesses like Jet AI's aviation segment, and clearly enhancing their customer offerings with new clubs and high-profile partnerships. They're undeniably making a bold play for market dominance in a very specific, integrated way. It's a story of significant aspiration.
That's the strategic vision, and it's certainly compelling in its ambition. However, these strategic moves come at a significant cost, as we've seen clearly evidenced by their consistent and, well, accelerating losses, those deeply negative margins, both gross and operating, and a precarious balance sheet.
Yeah, the financials are tough.
The negative equity and very low liquidity ratios paint a picture of a company that is burning through substantial cash to fuel its growth without yet achieving operational efficiency or sustained profitability. It's a classic high-growth, high-cost strategy currently, characteristic of a scale-up rather than a mature, profitable enterprise.
And the success of this vertical integration really hinges on
On whether those operational controls eventually translate into significant cost savings or maybe premium pricing power down the line, ultimately shifting those negative financial metrics into the black, that's the whole bit.
And the market's reaction to all of this is, frankly, quite mixed, presenting a fascinating paradox. You got this significant long-term stock decline since their IPO, a clear downtrend over the past 3 years, indicating investor disappointment, maybe with the initial promise.
Right. The long-term trend is down.
But that's punctuated by these recent, very sharp short-term gains, which seem to be overwhelmingly driven by specific positive news events like those favorable recent earnings readouts, the inclusion in the Russell 2000 index, and those strategic acquisitions.
It's a stock that responds dramatically to headlines and technical factors.
Yeah, sometimes seemingly independent of the underlying financial realities.
Precisely. It implies that the market is currently reacting more to narrative and event-driven catalysts, those moments of perceived future potential, than to the underlying financial fundamentals. The short-term euphoria seems disconnected from the persistent unprofitability and balance sheet concerns, creating a sort of speculative trading environment.
And then there's the ownership structure, which creates a truly unique dynamic. You have incredibly high insider control. The founders and management essentially own the vast majority of the company.
It's huge insider stake.
But juxtaposed against that, you have a notable and significant flight of institutional capital, with that massive reduction in their holdings. It's a clear divergence of confidence.
A little split ticket, yeah.
So it suggests a company that is largely still in the hands of its founders and original visionaries, perhaps with limited external validation from those larger, more sophisticated institutional investors who have seemingly decided to significantly reduce their exposure.
It's a fascinating paradox. The internal conviction seems incredibly strong, but a key segment of the external professional investment community is signaling skepticism with their actions by selling. It truly is a unique landscape, a real tug-of-war between bold vision and financial reality.
It is, and that dynamic makes for a very interesting and potentially volatile investment landscape.